Hi guys, I'm Josh Brown. My friend Brendan Ahern is the founder of Crane Shares, which also happens to be the sponsor of this week's episode. And I wanted to let you know one of my favorite information sources is Brendan's very good China Last Night email blast. Every night, Brendan stays up till probably, I'm guessing, 1, 2 a.m. He's got the latest headlines coming from Asia, all of the stuff that may or may not affect the next day's trading, and he puts it all together into a really great, easy-to-read summary, all the headlines you need, the backstory behind the headlines when necessary, and he's really covering everything, whether it's Chinese ADRs, or it's currency stuff, or it's political things, or trade, or the US dollar, just you name it. Brendan gets it in there. He's a very good writer, very succinct, most importantly. So I would send you to craneshares.com or ChinaLastNight.com to learn more. Thanks to Brendan. Thanks to Crane Shares for sponsoring the show. All right, this is a big one. This is a big one. We have one of the smartest people I know, I've been informed, in the house today. I've been looking forward to this episode since I begged you to do it a few weeks back. Dan Greenhaus. Dan Greenhaus, ladies and gentlemen. Are you fired up?
I wouldn't go far
in front of you?
I wouldn't go far as to say I'm fired up, but I'm certainly aware that I'm here.
All right, we are very fired up. We wrote a little intro for you. Can I read it? Okay.
Please.
Dan is a male model and chief economist and strategist at Solus Alternative Asset Management, and you are a CNBC contributor. You are?
I used to be.
A former CNBC contributor.
Sure.
Okay. Solus manages $3.3 billion for institutions and family offices, specializing in event-driven, distressed, and special situation investment opportunities.
It's a lot of special situations these days. A lot of events. Things are being driven. Go ahead.
Prior special situation Solus, right now with these armchair things.
That's a special situation.
Finish.
Prior to Solus, Dan served as chief strategist at BTIG and Miller Tabak, started his career at Bear Stearns in 1999. Dan Greenhaus, welcome to the show. I think I met you probably in the Miller Tabak days. Does that sound about right?
You and I know each other for, yes, a long time. It feels like.
Well, also, I think when we met, it was like, oh yeah, you're a Long Island guy working in finance. So
I think that's right.
We had probably knew a lot of people.
To be Jewish.
No, we're the same age.
Yeah.
Are you the same age?
There's not a lot of white Long Island Jewish people in finance.
No.
And we really, and we bonded.
Yeah.
We stuck out like sore thumbs.
And we had other, Joe Weisenthal was among.
Joe, oh yeah. You know Joe?
The last time you and I saw each other, we had dinner at Domino's in Midtown with Joe and Lynette Lopez.
Domino's.
Domino's?
Pizza?
No, yes, Domino's Pizza.
What?
Yes, there was a Domino's on like 42nd or 40-something.
In New York City, we ate at Domino's.
We were out somewhere at some event celebrating something.
This was during the earnings recession
it was
of 2015.
upstairs.
How drunk was I?
We were all
okay. Oh, I do remember that.
There's a pizza place upstairs
because it wasn't planned. It was like we were somewhere.
I was there.
You were there.
I was there.
Okay.
Why did we end up in a Domino's?
I don't remember why.
Was it Domino's?
It's coming back. It wasn't Domino's.
It could have been Pizza Uno.
Yeah.
It could have been famous
Sal's. But it was an after an event.
It was
thing.
after an event.
It wasn't like let's all meet at Pizzeria Uno.
I feel our listenership just cratering right now.
Actually, it was Fridays. It was Fridays by Penn Station.
No,
yes, it was.
I wouldn't have walked in there. That's
yes, it was.
It could have been Doc's. I don't know.
Be that as it may.
Here
we are.
So, all right. So, I think I met you back in the Miller Tabak days. So, bring us up to speed though, because the most interesting and mysterious thing about you is that you are one of the smartest people I know, and you're one of the volume up people. You know what that means? Volume up people.
I assume that CNBC's on mute.
Well, Bloomberg, Fox, but
sure.
Just in general on trading floors on Wall Street, they don't have the volume on because unless there's something going on.
That is accurate. I've never walked into a client's office and had the volume on television.
No, and it's not out of disrespect. It's just the nature of you're working, you're on the phone, you're doing. But there are volume up people for me. You're one of my volume up people. I would genuinely want to hear what you have to say.
I'm flattered and I appreciate that a lot. I'm genuinely happy to be here. I miss the two of you. I'm glad that we're all together again and can
time out. But now explain your disappearance. So you were a regular. You were a contributor.
I was a contributor in the mid-2010s or whatever it's referred to.
Yeah, no, you got that.
I moved from the sell side to the buy side to what as you mentioned, Solus Alternative Asset Management. And being the buy side, your public appearances are limited. The last couple of quarters, we've sort of loosened up a little bit, and I've started to peek my head out, and that's particularly on Scott Wapner's Closing Bell show. We're all up here, call it every 2 weeks.
Scott is the best.
Scott, I have nothing but the nice things to say about. You recently had Bob Pisani on, who also
Bob
anybody
is the
who's
best also.
Anybody I think involved with CNBC in any way has only the best things to say about Bob and Scott, and so so I'm happy to be there, and I'm thrilled to be here. So thank you again for having me.
All right, so you have reemerged, and we're so happy for that. We're going to start with the fund manager survey. Michael, set this up for us.
All right, there was a tweet talking about the fund manager survey that comes from Bank of America. I forget who said this at Bank of America. It might have been Hartnett. I can't remember. Said, this screams macro capitulation, investor capitulation, start of policy capitulation, meaning that cash levels are at the highest level since April 2001. Your thoughts?
Let's see. I mean, it seems pretty pronounced to me, but it hasn't worked. Like, this kind of sentiment stuff hasn't worked all year. Like, we really haven't had any meaningful reversals from it.
I think when I hear people talk about capitulation, it's ethereal in the sense that I don't know that there's any actionable trading strategy that you can ascertain from any of these data points. Listen, cumulatively positioning certainly matters. You can look at positioning in the CFTC data that comes out, the CME data, and you can surmise that people are not long equities right now. And the fund manager survey, and for listeners that may not be aware, this is a real survey that a lot of people pay attention to. I'm not at all surprised that cash levels are very high, but it's also to some degree telling me something I already know, akin to margin debt. The market's up. There's a lot of margin debt. The market's down.
It's coincident. When stocks are down, cash is up, and that's why stocks are down.
That's right.
It's like it's cause and effect. We understand that. So there's not a lot here. What is this showing us?
Similar thing from the fund manager survey. We're looking at allocation to equities and inflows, and both, as you would expect, are going down.
But I got to say, there's a linear relationship between stock prices and bearishness, in the sense that obviously the lower stock prices go, the more bearish people get, and I am sure you encounter this in your world. In reality, the exact opposite should be true. When stocks are at their all-time highs, and that's not to say they can't go on to continue to make all-time highs, but when risk assets are at their highs, you're supposed to be a little more skeptical. And when the stock market's down, 25%, 22 today, but 25%, you're supposed to really be starting to think about, what are my 1, 3, 5-year time horizons looking like, whether you're on the institutional side as we are, or I imagine on the retail side as well. These are the moments when you're supposed to start lining up and even starting to dip your feet into the water, so to speak.
But the problem with that is, if you get burned doing that once, you stop. So the the June low, you made a new low in September for the major averages. But that was also one of those screaming capitulation moments. John, you got that? That was also one of those screaming capitulation moments in like June 16th, when the market made its low. You had a bounce, and then you had lower prices in September. So it's like, so you say to yourself, all right, I got bullish and I got burned again. I'm probably not going to play that game.
Well, listen, I don't want again, I can't speak to the retail investor. You guys will.
Well, you are right now, so
speak for the retail investor. I apologize. But this is not dissimilar to 2002. The market made a low in the summer of 2002 after just the abysmal summer that year, and then went on to make a subsequent low in October. And then obviously that ended up being the low, retested in March of 2003, and off you went. But even if you bought at that summer low in 2002 and were, so to speak, out of the money by the fall, a year later you were way up.
It didn't have to be the low.
That's right. And so the table here that I brought with me is, I put this on Twitter, although nobody seems to follow me on Twitter, but whatever.
You're so much better off, dude.
Anyway,
so much better off.
I just went back to 1960. Basically, that's usually my starting point, since that's basically when the S&P came, as we know, it came into inception. Just when the market's down 25% from a given cyclical high, how do you do going out a series of time frames? And the line item I'd want you to draw your eyes to is the percentage positive line. And you can see 1 month later, you're up, call it 2/3 of the time. That's sort of a random occurrence, since the market's generally up 2/3 of the time. But when you start going out 12 months, 18 months, 24 months, the S&P is almost always higher.
So 24 months after the S&P falls 25% from a high, which we just did in September.
That's correct.
And I think when it wasn't, it was like 08 and maybe 74.
Hold on, 95%. 95% of the time, you have positive returns. And
For the index as a whole.
Yeah, and the median is a 23% return, which is way better than average over any 2-year period.
And again, it's just basically telling you what you know, which is
when stocks are low, you want to buy them.
When stocks are low, you want to buy.
So why does everyone have so much trouble with that, from retail to professional to institutional to consultant? It works. It works against what we want to do psychologically. Like when we're in pain, we want less pain. And when things are going great, we don't want to leave. We don't want to leave anything else on the table.
Yeah, I mean, there's a huge behavioral economics component to this, but from years of meeting with investors, I mean, listen, this is half the equation. You're supposed to buy when market's down, but when you watch when you watch CNBC, as you know, we all are on. The market's down. You got to buy. You got to think long term. Where are all these people?
Which is the right advice, though.
Which is the right advice. And I know I'm looking at your boy Nick Majuli.
Yep.
Just keep buying.
Just keep buying.
It's good advice.
You know, in theory, you should always just keep buying until it's time to retire. And I think from the RIA community, that's absolutely the right message. On the institutional side of things, you're supposed to be advising people when you're at the top and saying, hey, you know, now's the time to start raising cash levels. That's always very difficult to do because of career risk and underperformance, and then you start risking losing AUM.
Well, there's also, on the institutional side, you're being judged against something.
It's the S&P.
Right. If you're a retail investor doing it yourself, you don't have to report your results to anyone but your spouse, right? And yourself.
Yeah.
I think the reason why this particular moment in time does not feel so obvious, the numbers that you said are empirical, factual, correct. We know that. What's making this challenging, I think, is that everyone knows a recession is coming, and we're going to talk about that. And yet we haven't really seen the economic data turn yet. And I think investors are wary of getting too aggressive on the long side when the data hasn't even begun to really soften.
Can I just, before you even answer that, not that it was phrased as a question or anything, but have you ever seen anything like this?
No.
Where the CEOs of the largest banks in America are promising you a recession. People like Jeff Bezos are saying batten down the hatches. I don't know that anyone has a better sense of like what's going on with the consumer.
Central bank chair is using the word pain regularly.
They're saying pain, which is their way of saying recession for political reasons. They don't say recession. They're guaranteeing you they want to cause a recession. I can't remember anything ever like this before. Can you?
No. So earlier this year, I went in preparation for this. I went back and watched. There was a video of me on CNBC in January, and I wanted to look at that one because I remembered that I referred to something that you had said the day before, and I can't speak for everything that you said because it's quite voluminous.
It's a lot.
It's just too much to handle. But at that time, you had said something about this is going to be bad. Because the next day I had come on the halftime report and had echoed your concerns because I was pretty concerned coming into the year. I certainly didn't think we'd be down 25% by the middle of the year, but the Fed was telling you, guys, pay attention. What's interesting about this is historically, this is not what happens. The Fed raises interest rates. The market usually keeps going up. I mean, just think about 04 through 06 when the Fed hiked from 1% to 5.25. They hiked by 425 basis points. The market went up the whole time. Mm-hmm. And when you were supposed to sell was when the curve inverted and the Fed shifted into starting to cut. And obviously that's 2008. And then when the
times.
Much simpler times. So to your point about have you ever seen this before, part of what I brought that up because part of what I was saying at the time, and I wasn't alone, but it was a smaller camp, was really all this data is completely irrelevant because the only thing that this is too simplistic, but for now, the only thing that matters is the 70s, which is the last time you had an inflation level even close to, obviously it was much higher. How the Fed performed, how markets performed, how assets performed subsequent to that in the era of declining inflation is to a large degree irrelevant. And I guess in retrospect, I guess I'm not surprised to see what's going on. But at the same time, as it's happening, it's not what's supposed to happen where the market—
Well, with disinflation, the Fed is trying to keep the economy growing. Regardless of the recessionary pressure that's coming in, the Fed's trying to fight it. This time it's backwards. The Fed is trying to bring about a short, shallow recession to prevent a worse case scenario later. So it seems almost like un-American. It seems like wait, we're all rooting for job losses, lower stock prices, lower home price, but we kind of are.
Yeah, I mean, well, it's not that you're not rooting for those so much as you're rooting for lower prices.
But that's how you get them.
I should say prices are never coming down. Okay. If you look at the index, if you look at the price level itself, just think about the price of a porterhouse at Peter Luger's. The price of a porterhouse at Peter Luger's, a Wall Street staple for years, never goes down in price.
Recession-proof.
Recession-proof.
Except
sales
for
on
the
it.
except for the pandemic when they couldn't sell any. But yes.
A pandemic is obviously the exception. But the price level in general is not coming back down. The burger at your local restaurant that was 14 and is now 18 is probably not going back to 14. What the Fed's trying to do is just slow the rate of increase.
That's right.
And the part of the way that you have to do that is through tightening monetary policy and job losses. And I know the big debate today is how much of this is out of the Fed's control, so to speak. And it's true. There's a lot of this that they can't print oil wells. They can't print better fiscal policy, if you will. But there is a demand component to this. And the Fed has looked at this, and a number of private sector indicators have looked at this. We know this story. This is not anything new. But subsequent to COVID, we gave everybody $1 bazillion, 100 different ways, and they started buying stuff because they couldn't do things.
Right.
And the chart we have up here is core. In black, you have core services, and in whatever that is, orange, you have core goods. And you see that subsequent to COVID, there was a huge spike up in the price of goods. That's soccer balls, that's basketballs, that's stuff you could actually buy, dumbbells, shoes, cars.
And that price comes back down.
Those prices are starting to come down. But
Fast.
yes, and this is when Jeremy Siegel goes nuts on TV, and other people echo those sentiments. This is what they're looking at. But the flip side of this is the black line, which is services, which is not only apartments and rents. It's also how much it costs to get your lawn mowed,
and that's like the wages piece.
And that's the wages piece. So what the Fed has to do is say, okay, how much of this is supply driven? There's wide estimates. Let's just make it up and say it's 50-50. Yeah, a lot of this is supply chains, which we know have normalized. You've talked about shipping rates, the quantity of goods coming in, the number of ships at port, the dwell times, all of that has moved in the right direction. Yeah. But the other side of this is we have an extremely tight labor market. And the Fed, which is staffed universally by economists who all took the same classes at the same schools from the same professors, are all looking at this and saying there's a labor side to this that we need to untighten in order to bring down.
But the mechanism you use is the controversial part. How do you untighten the labor market? Well, you make it so that corporate profits get hit, people get thrown out of work. You knock down the value of houses so people stop spending like they're Gatsby.
But this doesn't happen
and you f up the stock market.
Corporate profits are still at all-time highs.
Well, that's my point. Like, you need time for that transmission mechanism to take effect, and that's where we are. We're in the middle of that period.
Dan, let me ask you.
What are you missing?
No, I didn't number any of my
pages.
I don't know.
We'll get to them. Let me ask you a question. Maybe this is wishful thinking. Because everyone seems to know or anticipate a recession coming, the market has done a lot of the work for us already. The NASDAQ fell 35%. The S&P fell 26%. Is it possible that this will be one of the only times where the bear market ends before the recession even begins?
Yeah, I mean, so we all know historically, on balance, the stock market usually bottoms, call it 3 months or so, 4 months before the recession ends. But what's interesting about this is you've had a pretty substantial decline in equity prices. The point I've made repeatedly is people our age are accustomed to the idea that a real bear market is a 50% drawdown in prices.
Yeah. We think we need to see the full thing.
We experienced that in 2000. We experienced it in 2008. Obviously, a little less, a little more. But the reality is, when you look back historically, that's not the 1990 bear market was 20%. The 62 bear market was I think only about 30%.
Yeah.
Obviously, you have 74, which was also quite large, but 25% is a pretty substantial decline in prices. And to the extent that you are trying to ascertain how much is quote unquote priced in, a simple rule of thumb or a simple back of the envelope way of doing it is, well, normally you fall 30%, 35%. We fall in 25%. Do the math. We're pricing in 70%
but here's the
of
problem.
a recession.
It's where we came from. So you're not falling from a normalized valuation. Like the 07 peak, we were probably 17 times earnings. We're falling from 24 times earnings. So it's not quite 1999, but it's also not a garden variety valuation that you're starting from.
Remember when we described Dan as the smartest person we know? Look at this guy. He's got papers all over the place.
First of all,
there's like a method here.
First of all, they're not stapled. Second of all,
there's like a method here, though. Let's see what happens.
No, this is genius. This is genius at work. Watch.
But he has a system with John. It's like a signaling system.
This is like Sonny and Bono.
Yeah,
I feel very comfortable just flashing.
John, slide number 954.
Well, I've got you, babe. Am I right?
Yeah, earlier when we were singing it together, it sounded much better than it does now. But to your point about the valuations, you can also look at this through the prism of valuations.
We have this up.
Which is okay. So let me go through these two charts first, and then we'll get to valuations. First, the chart on the left is your average price decline during previous recessions, with
that's good.
with the horizontal line on the left chart at about a third. So the normal bear market is called a third. This is historically, I've included 2022 at about 25%. And you can see what each recession brought about in the form of lower stock prices. On the right is what happens to earnings. I've not penciled anything in for 2022 because, as Michael correctly pointed out, they're basically flat. But you can see historically, you talk about EPS declines somewhere around 10 or 15% or so on average. Obviously, this is a relatively small sample set, but it is what we have to work with in the post-1957 era. On the valuation side of things, the number's about a third as well. Valuations normally compress about a third.
Okay.
And if you take 15 or whatever where we are now and divide it into the 22 where we were, that's about a third.
We did it.
So to your point, from a price standpoint, you're about average.
But we haven't even had the recession yet. That's the problem.
That's why people are so freaked out.
We did all this work. See? We did all this work to the downside on valuation, on price. We took a lot of the excess out. We took SPACs and recent IPOs. We knocked stocks down 90% in some areas of the market. We've done all that, and the shit hasn't even hit the fan yet.
Yeah, and so, but before we talk about that hitting the fan, I want to make a quick point here about, because you said we haven't had a recession yet, and I'm a little late to the conversation, although this is the first time I'm on the show.
Yeah. I
wanted to make a point to the viewers to think, well, what do you mean we had 2 quarters of GDP? We already had the recession. I agree, it's not a recession.
We added 4 million jobs during that time. I don't think it qualifies.
I agree. And just for the viewers at home, this is the recession in 2008 and the recession in 2001. And I would just 2 observational points. The first is in 2008, in the second quarter, GDP expanded by 2.5% or so.
Did it really? The second quarter of
08. The economy grew.
Huh.
Consumer spending was positive. And yet no one thinks that we were not in a recession in the second quarter of 2008. So the fact that there was a positive GDP print in the middle of what is a larger recession
doesn't mean
anything.
Right.
And in 01, an even more interesting point, find me in the 2001 recession the 2 quarters in a row of negative GDP.
Oh shit! Look at that. Wait, so 2001. Obviously, we all knew we were in recession at that time.
That's right.
There was no debate. You had Q1 minus 1.3%, Q2 plus 2.5, Q3 minus 1.6, Q4 1.1.
Yeah, we did the 2 consecutive quarters of GDP thing is dumb. We know that stuff.
Okay, well, you should have told me that before I went off on this tangent.
No. Even National Bureau of Economic Research is not stuck on the 2 consecutive
Yes,
quarters.
I just saw, before we get into we already had the recession, I brought the slide. I wanted to use it.
So we spoke about, but here's the thing, and I know market cap is not valuation. Google's still $1.3 trillion.
Fine, but down from 1.6.
But no, down from 2.
Was it 2 trillion?
Was $2 trillion reasonable?
Well, not from the lens of
Listen,
today.
price is truth. I hear that on CNBC all the time.
All right, so I have a little bit of a contrary take, though. What if cash balances are rising and it has nothing to do with capitulation? It's just that here's a free 4% and never worry about anything ever again. Isn't that so we're looking at everyone's in cash. Yeah, because they're getting 4%.
Dude, they have to sell something to be they're not selling cash to buy cash.
Understood. But sell something that could move, that has standard deviation of 20 or 25 versus being in cash
and earning 4%. No, it makes sense. But they are selling stocks. It makes sense.
I understand, but that to me doesn't scream capitulation. If you tell me they're in cash and they're earning 0 like they were 3 years ago, that's capitulation.
Agreed. So on this point, it's this conversation about TINA and equities
dead.
Is clearly dead, but it's not just treasuries. This is the yield on the high yield bond index in black and the yield on the investment grade index on the right-hand side,
which is crazy,
in orange. You can now, for the IG index, which is obviously the supposedly best quality companies, the index itself yields 6%. So you forget treasuries at 4%. You can go in and get high quality investment grade corporate bonds paying you 6% or so. I should have some cash and make that adjustment.
You're senior to the equity tranche. You have less.
Do you have a CFA?
I did. Less volatility, and so looking at people quote swing to cash and saying, oh, they're capitulating. No, they're just not stupid.
And for not a ton of duration risk, we were looking at a 1 to 5 year corporate investment grade ladder with Apple and Goldman and blue chip names at almost 6%.
Yeah, admittedly, a large portion of the IG have maturities in 2050, 2080. I mean, obviously you're much more susceptible.
I was talking about the 1 to 5.
Yes,
Like, and even still.
Yes, you can, and especially when you come down into high yield, you don't borrow for 30
So, but anyway, just to button it up. So that's why I think we should be careful about looking at global portfolio managers or retail going into cash when you consider what they can earn in cash and understanding it's not all fear. A lot of this is just rational allocation because shit has changed. Like we're in a different situation.
However, this is from Rob Anderson at Ned Davis. He said margin debt is off the record high set last year, and the speed of the deleveraging suggests excessive investor pessimism, reversal from extremes, which we have not seen yet, have been followed by above average gain. Okay, we know that.
Can I ask you guys a question?
Yeah.
Why does this, and I don't mean this disrespectfully at all. Why,
Now you got to ask.
why does this matter?
Margin debt.
Doesn't matter.
Yeah. But
look at it. It's the same chart as the
here's
It's the
S&P.
same chart as the S&P.
It is. But here's the thing: the 15-month rate of change. The 15. Look at the red. The 15th-month rate of change. I think this matters.
So we're saying that there's less speculative trading activity once the market has already fallen 20%.
I don't know, and it might. I don't know that this 15-month rate of change matches up perfectly with the S&P. It could. It very well could. I think we're saying the same things.
I generally have found margin debt to be like the most coincident indicator of all coincident indicators.
Well, listen, I think it's bullshit on the way
there with
up.
trading volume, by the way. When is trading volume at its peak?
What I always say, and you know what else? Oh, yeah, but the price of gold. The stock market's up, but gold.
Yeah.
This was the whole thing. My mom never opens up her Schwab or TD Ameritrade statement and says, "Oh my God, I was up or down 10, but did you see gold?"
No.
Or, "Oh, yeah, but I mean, margin debt is up, so I really better be careful about these gains." I find that to be an irrelevant metric in the larger scheme, either of analyzing the market and doing
You know what
forecasting.
margin debt is great for? It's great for Twitter.
It's content. It's good content.
It's really good.
Is it good content?
Well, no, it's great for alarmist Twitter because
That's the thing?
because it always looks like this is a maniac bubble. It's about the burst. It's like, oh no, it probably will rise with the market, and then when the market falls, it'll fall off.
Are those people also tweeting about the amount of debt outstanding at the federal government?
Yes, of course.
And our unfunded pension liabilities?
It's in the same playlist.
Josh, what's this Bank of America stuff?
Wait, hold on. We didn't do this number of times.
I thought we could skip over. That's okay. It's okay.
Well, let's do it
All
anyway.
right.
Do we have John? Do we
Tom
have this?
Serafegas from Bloomberg plotted the S&P 500 with number of times capitulation is mentioned. I'm guessing Bloomberg is scanning all the news articles. And
yeah, wait. How many times capitulation is mentioned in their own articles?
No, I'm saying
let's skip.
I'm saying in all articles.
Okay.
But I agree that you don't need to nail the bottom to know that this is a good buying opportunity, right? Like, don't look a gift horse in the mouth. And when equities are off 25%, can they go down 40? Yeah, sure, why not?
Yeah, I mean, the risk that you run into is you buy in October of 1929, and it takes you 54 years to get your in real terms.
If that's what ends up happening, though, like what? Here, all right. So this is the story count for the search term capitulation, and it's actually way off.
Wait,
its
I
highs.
can't. Is this a bullish or bearish divergence? I don't even know what we're looking at
I'm
here.
going to go ahead and buy on this.
Because it was higher in June than it is today. So is there apathy? I don't know.
Can you imagine like this is your trading model?
No,
just
it's
apply
just a tweet. It's
apply
just a
to in
tweet.
20.
I would file this in the same cabinet with margin debt.
All right. I like when we can I tell you something? We talk to a lot of people who are always adding new things. I like people that are like, throw that out, throw that out, throw that out. That to me, that's more valuable.
I
these
operate
days.
under the assumption that there are cameras on right now on us.
There are.
And why would I want that to stop and show a chart of something unless it's of particular relevance?
Agree. We shouldn't
Keep it rolling. Josh, there's some good stuff in here. What's this?
I feel very strongly that the viewers want more of us.
This is from Bank of America. I like their stuff a lot. And John, we're going to go to this B of A data analytics. Basically, this is just more on positioning and specifically here. Let me set this up. Surprisingly, though, this angst is not reflected in positioning data. Global equities have accumulated inflows, not outflows, of USD $169 billion year to date.
Nice.
ETF inflows $417 billion, more than eclipsing the redemptions from active funds, which is minus $248 billion. Trends are similar across client categories: hedge funds, institutional, private, corporate. Everybody is a net buyer of U.S. stocks over the last 3 months, all categories. Active U.S. household investors, which they call the $40 trillion whale in the equity markets, have still not sold enough to reverse the $4.2 trillion of inflows registered in the last 2 years. So in other words, everyone's bearish. Everyone knows a recession is coming, but no one's actually selling. In fact, we have a stock market down 20-something %, and net positive inflows of over 100 billion. What do you make of that?
I don't.
There's no signal there for you. I guess you can't call it capitulation is the main.
I guess you can call it capitulation if people keep, but again, I don't know why I'm searching for capitulation. From my standpoint, there are many other things that you would want to focus on to determine whether there's a quote unquote bottom or a better buying opportunity than some.
You don't need actual capitulation to make that determination.
No, and I wonder, thinking out loud here as we're talking, what the origin of the need for capitulation is. I guess, you know,
I think it's muscle memory.
Looking back on it, March 09 was capitulation in the sense that people were like literally jumping out of a window when you made new lows.
Yeah.
And I imagine it was the same in 74 at that bottom, which was cataclysmic if you read the news reports at the time. But I don't know that what do I need?
We could end in apathy. Why not?
Why not?
Something this big, I feel like it would be tough.
Something what big?
Something as big as this, a regime change from 40 years of declining interest rates that all of a sudden makes this hard turn to where the Fed is no longer your friend. Like, it just feels like it's too big of a moment to end in apathy. Although I submit that some bear markets have ended in apathy.
Yeah, I think that's probably right. I also would add, I think you just touched on something that we haven't spoken about yet, and is probably the most important item for any listener or for us to—
2 year? This is a 2 year yield. Is that where you're going?
No.
Oh, I'm sorry. Go on.
Now my train of thought is completely go to commercial.
I
You just touched on something that is the most important thing for people to be thinking about, and I would argue for you guys to be talking about, which is the regime change from 30 years of declining interest rates, 30 years of China exporting deflation, and what the next 10, 20, 30 years are going to look like. Because that decline in interest rates, the 2 year, has underpinned— not exclusively, because this is the stock market and risk assets are largely about earnings, but has underpinned the valuation expansion that we've experienced from the single digits in the 1982 to the peaks in 2000 and now.
Yes.
And what does the next 10 and 15-year investment landscape look like if you don't have that much of an underpinning, so to speak? And the Fed's, I think to some degree, the Fed is on, to a lot of degrees, but the idea that you want to get inflation under control— you talked earlier about how this is like not something you want to do, put people out of work, and obviously you don't. But the battle against inflation, to not over-dramatize it, but to completely over-dramatize it, is the story of the day, is the battle of the moment. Because if you don't win that battle, everything else is subordinate to it, because you're going to have to come back later. And the resulting decline in valuations is going to take— we're all talking about 300 to 3,500 as some sort of a bottom. That's going to be, a wishful thinking if the Fed doesn't get this right the first time.
But that is the necessity of the recession. We've never had inflation spike above 5% and fix it with anything other than recession. So that's the necessity of it. And it's ugly, but it's true.
Yeah, let me just— we've never had inflation above 4% and an unemployment rate, or inflation above 5% and an unemployment rate under 4% solved without a recession.
That's correct.
That is, and that was my argument at the start of the year.
I apologize for cutting you off, but you were talking about interest rates, so I'm not sorry. So I was right. The 2 year is at 4.6.
Okay, no, if that's how you feel, I appreciate it.
And the 10 year is at 4.2. They're just going vertical. So maybe you could say, listen, stocks were maybe appropriately overvalued for a 0% interest rate world. Now that's no longer the case, and even though multiples came down 25%, they could still have a lot longer to go.
Yeah, no, I think— listen, should stocks be trading at 20-something times earnings with interest rates at 0 and a pretty good growth environment, friendly energy, blah, 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 blah? The answer is probably yes. Because what are multiples? They are confidence.
Vibes.
I heard something about vibes on what— the TikTok.
She popularized vibes. Yeah,
yeah, I don't know.
They're vibes. It's how we feel.
It's another way of saying sentiment.
Listen, you can model out what— one of my problems with people on CNBC is they will just slap a 12 multiple. Like, there's a reason why the market multiple sometimes is what it is.
Well, it's as unpredictable as anything else.
No, that's right. But you can. It's for sure, but it's inflation, volatility, it's interest rates, it's positioning. But yes, it's as unpredictable as anything else. But in a pre-COVID environment, a 20 multiple is perfectly reasonable.
Right.
Now, obviously, is the right multiple, 12, 14, you have no idea. And this is, again, going to be something of a battle because the idea that we're going to go higher because the multiples then going to subsequently expand from, call it 14 times or 15 times forward to 18 times, that's not happening.
You got to hire multiple throughout the 20-teens decade because the Fed was in a position to rescue the stock market anytime it got into trouble. What happened in late 2018 was the latest example. And that was actually the example that I think really converted everyone. Like, this is just an upside. Because when the Fed did its pivot and they go from, 2.5% interest rates back down to 1.75 because the S&P fell 20%.
He said
that was just like 2019. You then got a year with a VIX of like 8 and 30% returns to the S&P because that's the moment. All the people that had been fighting the Fed and fighting all the QE programs, that's when they said, you know what? Actually, they didn't say this out loud. I'm wrong. Valuation doesn't matter. Just buy the best stocks and shut the hell up. And like that was the regime prior to COVID. We're not ever going back to that, or at least not in the next 5 or 10 years.
Not in the immediate
future. Because the
future.
Fed can't save the stock market anymore. And as a matter of fact, right now, one of the guys is saying, I was happy to see the stock market down. Kashkari. So it's a totally different world. So I agree with you. That's what's changed. What does that mean for multiples? Well, it means kiss 20 goodbye. I don't know if it means we can't have 16, but I don't think that we should expect them better. So now it really becomes more about fundamentals.
So 2 points. One, Fed members really should stop talking
oh,
so
God.
much.
Cosign. Cosign, please. I wish they would stop.
I'm fine with increasing your open mouth operation, so to speak. But it's
no, I'm with you.
I was not aware we were in front of a live studio.
I'm with you. I wanted to stop too. I wish they would shut up.
Well, I don't even mind. But it's the repetitiveness and the volume is a little much.
What's the likelihood that happens?
0.
0% chance.
Look at you.
0.0.
I think they're feeling themselves.
Wait, Dan was making 2 points. What's the other
I've
point?
not forgotten.
Okay. Well, let me ask you
the
this.
audience applause just totally threw me off.
We've spoken about the VIX repeatedly over the last few weeks. Why isn't the VIX going up? Right now, the S&P 500, it is Thursday at 340. The S&P 500 is down 1% on the day. The VIX is also down 1%. It's at 30. Why is the VIX not telling us what we think it should be telling us?
Listen, let me ask you this. Where should the VIX be? 40?
Why have we not seen a single spike?
Have you
above say 35?
Is there an event that warranted a spike?
Perhaps last Thursday.
When you look historically, I mean, the VIX was 20 pre-Lehman.
Yeah, that's true. That's a good point.
The stock market was down 20% on I think the Friday before Lehman. You weren't down, and I know this because of the 25% table from before. The stock market was down 20% pre-Lehman in mid-September, call it. VIX was 22. And then Lehman happened, and there you go. And in the 2000s, I think it's something similar. I mean, when you look in the 2010s, which I'm much more familiar with, the only real spikes were in 2010 when Spain was downgraded and everyone realized this wasn't just a Greek problem. Then you had 2011 with the debt ceiling.
15.
You had 2015 with the China deval.
Those were events. Those were moments.
That's how you get. Listen, I'm no vol and VIX expert. You can bring on someone else, but. That's how you get those spikes. Otherwise, you've had, for lack of a better word, an orderly decline in stock prices that, granted, has gone on for 10 months. But where in there would you need the type of hedging activity or exogenous event that would warrant a 40 VIX? Based on the last 15 years of data, I would argue that, think it's unwarranted.
So I think if we're going to have it, it's going to come from one of two things. It's going to be something to do with the dollar or the treasury market. I don't think there's anything with stocks that could unnerve us to that degree right now. So I think it's going to be something to do with the treasury market, some kind of blow up, or it'll be geopolitical, and who the hell could predict that?
Speaking of the treasury market, I don't know if you guys are aware of this, but the Treasury Department is on the verge of doing a treasury buyback. Are you aware of this?
Wait, what?
Yes, but they're going to call it something else. They're not going to call it monetization or anything like that.
Well, it's not I mean, I guess we can get into semantics.
Yeah.
So one of the biggest stories that I don't think gets nearly enough play on television, or I assume among your viewers, is the illiquidity in the treasury market, which has risen to such a degree that Janet Yellen is talking about it.
Yeah.
And she's doing it, and other people are doing it because the Treasury Department has already basically surveyed the primary dealers and said, hey, what's going on with this liquidity? Would it help if I came in and bought back my own debt?
Yeah.
And basically they have foamed the runway, so to speak, that by sometime later this year or early next year, they're probably going to introduce a program where they're going to start stepping in and buying off the run treasuries.
Because who else? Who else is going to do it? Who can buy in the size necessary to affect that market other than us?
The banks.
But they're not.
But they're
set up
not
that
because
way.
of the regulatory regime
That's right.
that's been in place.
We kicked them out of that game.
So basically the banks, whenever they do any risk-taking activity, however de minimis it might be, you expand your balance sheet, you have to segregate capital. So even holding treasuries and reserves is a limiting activity for the banks.
Well, this is welcome news. Treasury bond, the ETF has gone down for 12 consecutive weeks.
Oh, okay.
So
Well, what do you think of the ramifications of that if they say, okay, we're starting
Treasury
this,
stepping in.
we're starting this program, does the market like it? Or does the market say, what don't we know? And
they should start an ETF. I buy it.
I don't know. I mean, if you ask the Treasury guys, they'll tell you it's good news. It's not as good. It's not the best answer. The best answer is something on the regulatory front, but you're not going to get that. So the Treasury guys will tell you it's probably good news. When equity guys start waking up to these headlines, I think the initial reaction is going to probably be what's going on in the Treasury market. That
would be my reaction.
Why are they buying back their own debt?
Remember when
Wait,
Mnuchin in
illiquidity
2018?
in treasuries? Wait a minute.
Mnuchin said, "Don't worry." Out of nowhere, I spoke to the biggest bank CEOs in the nation. They say liquidity is fine. Everybody's like, "Wait, what the f are you talking about?"
Yeah.
And
Why
stocks
do we
tanked
even
the next day?
Why are we even talking about that?
It's Alan Schwartz going on TV saying, Bear Stearns liquidity is fine, like 2 days
Yeah,
before.
but Dan, this is a bigger story because the financial markets just ousted the prime minister of the UK, today. I'm saying, oil prices and dollar prices are now basically acting as the predominant forces in a lot of things that maybe they weren't even 6 months ago. What do you make of? This is a prime minister now with the shortest tenure in the history of England.
The big joke on Twitter, I think, was would she last longer than a head of lettuce?
And she did not.
And yes, and
The other one I saw was the Airbnb logo on 10 Downing Street.
Okay.
But whatever. So she basically got kicked out of her job by the financial markets.
That's good. Yeah, I can go with that. Listen, oil prices we haven't touched on them yet. This is a really big.
Wait, before we do that, John, can you give me this Joe Biden thing? Are you able to do that?
Yeah,
Okay. How right or wrong? We're going to play the president talking about whether or not we have an economic problem. I sort of agree with this.
What kind of ice cream do you think he was eating?
Pecan, butter pecan.
He's such a
thinking
putz
Rocky
with
Road,
the ice
maybe?
cream cone. Do we have
What are you
audio
thinking?
though?
Rocky Road.
No, it's vanilla. It's like vanilla.
Wait, hold
That's
on,
right.
hold on. Let's do that again. Proceed. If it's not going to work, it's okay. We'll put it in post.
Look at this. Look at that pose.
It's not going to work.
It's a screen share. It's not playing it for
All right, Joel, read what it said. Just read it.
He's not concerned about the dollar.
Yeah,
He's
do Biden
concerned
voice.
about
Do Biden
the rest
voice.
of the world.
Do Biden voice.
He's basically saying the reason there's an economic problem is because of how strong the United States is, and that
I'm
everyone
sorry to
else.
interrupt. We have to take the picture of him eating the ice cream off the screen.
No, I'm going to leave that up there for the.
I have ADD and I cannot concentrate.
All right, get him off. He made this not completely out to lunch idiotic point while eating the most enormous waffle cone filled ice cream. But it actually was not the worst point, which is that no, we don't have a problem. Everyone else has a problem. Is it that simple?
Well, the dollar is our currency and the world's problem.
Yeah.
I would add the strength in the dollar on a year-over-year basis, let's call it, is about as extended as it ever gets.
It's remarkable, right?
It's remarkable is the right word. The problem with that is historically when the dollar gets this strong, things start to go wrong. I wouldn't put the UK in that basket because I think the UK is a very idiosyncratic. She announced incredibly appealing supply-side reforms at a moment that maybe the market didn't want incredibly appealing supply-side reforms. I think it's probably a safe way to describe what happened. But the dollar doing what it's doing is invariably going to lead to – and I think you talked about this on TV today. I listened in preparation for this.
Very astutely, I might add.
Yeah, and correctly, I would. Things start to happen
Well, listen,
that are –
Nike just told us they missed out on $4 billion worth of sales this quarter
Procter &
because of the
Gamble.
dollar.
Procter & Gamble –
Think about how much money that is.
it's hundreds of billions of dollars in any number. I mean, you don't think Microsoft is going to talk about that? It is a
They've
major.
been, right.
But besides the translation effect, which is purely an earnings thing, I mean, but I mean, the primary way people talk about the dollar is through trade. well,
Yeah.
the strong dollar, it's good. It holds down inflation at home because it makes imports more
It
appealing.
gives us more buying power for stuff that we're
But
buying elsewhere.
the flaw in that argument is most trade around the world is invoiced in dollars already. So it's not exactly the
and U.S. households are not doing cross-border business.
no. There's not.
Like maybe Chinese stuff on eBay, but
There's not. I mean,
Right.
yes, I'll defer to Visa on cross-border transaction volume, but
Right.
but yes, but listen, imports are held down in price, all else equal. But again, I forget the exact number. It's 80 or 85% of global trade is already invoiced in dollars.
yeah. So my issue with the dollar is that we don't know the ramifications of running up the dollar's value. Not that we did it on purpose. The dollar running up in value versus everything else as quickly as it did. We know that there are 40 or 50 emerging market countries,
Sure.
all of whom are now, many of whom, if they're not like oil kleptocracies, they owe a lot of money in dollar-denominated debt, and this makes it really hard for them to pay it back.
You can segregate
You
the
start that
countries.
chain reaction.
Yeah.
So maybe less important, but just getting back to earnings, Netflix said for Q4 2022, we're expecting revenue of $7.8 billion, with a sequential decline entirely due to the continued strengthening of the US dollar for other currencies. So if we're not trading at 20 plus times earnings and we're trading at 15, 16 with this as a headwind, like where does that get us on the S&P?
But from a valuation, from an analytical standpoint, you don't get any credit for the dollar. I mean, there's always questions, why don't companies hedge their currency exposure? Because you get no credit if you get it right, and you get dinged when you get it wrong.
Yeah.
These things come in waves. I mean, we the last time the dollar rallied, it was a big story. Microsoft and Nike and all the Starbucks. It's what everyone focuses on. And I brought up Procter and Gamble because they just reported their number was like 6 percentage points lower than it otherwise would have been just because of the dollar.
Right.
So you think investors will look
Well,
past
no.
that?
Well, Wall Street says, "All right, we'll get it back on the other side." But the bigger story is, what does this do to the global financial system? Like we're congratulating ourselves. Look, the Fed did 400 something basis points of spoken rate hikes so far. They'll probably get there. So far, nothing's blown up. Okay, that's great. What happens in 23? A lot of stuff has to get repriced, and there's a lot of dollar-denominated debt around the world that is now way harder to be paid back.
And believe me, the EM guys have a Excel spreadsheet, and in column A is every country, and column B are countries with large current account deficits and high levels of external debt servicing needs. I mean, that's not going to creep up on anybody, that's for sure. My point about the dollar, and I said it already, but I'll repeat it, is whenever it gets this strong, things start to break. I don't know,
Where would you look? Where would you look for something that you think might be of note to investors in that regard?
Emerging market countries with large current account deficits and high levels of external financing needs.
Like,
Isn't it always Argentina? Who's always the one?
I mean, Argentina and Greece are in some stage of default, like 75% of the time
Perpetually.
in their entire history, something like that.
I think the market would yawn at Greece, but I don't think the market would yawn at some shit in Asia going wrong.
Yeah, I mean, listen, because it's not an individual. I mean, listen, we lived through Mexico and Orange County in '94. Argentina again has defaulted. I mean, from the U.S. equity standpoint, when has that ever really mattered? I mean, the U.S. has never gone into recession because the world has gone into recession. If you think about the Tohoku earthquake that knocked out the global supply chain, growth slowed a little bit, but we didn't have a recession here. We're largely impervious. We're what you might call a closed economy in that sense. I mean, we're not. I don't want to say we're impervious, but we're largely impervious to a lot of these.
So you're not like in your meetings, the people you're talking about, you're not really worried so much about like systemic stuff at this moment. There's nothing really out there.
Well, listen, I mean, the beauty of
We'll play this back to you when
listen.
when the British pound
Did
goes
Dan
to
just
zero.
say everything? We're in the clear?
Yeah, I mean,
He
believe
said
me,
impervious. Hey, Duncan, let's timestamp that.
Okay.
Duncan, don't be afraid to not timestamp it. No, I'm not saying. It's not that I'm saying everything's okay. It's that in 2008, there was so clearly something going on under the hood. Nobody knew it. I mean, I shouldn't say nobody because a couple of people went on TV and like walked it right through. But something was wrong. You didn't know what.
Barry Ritholtz. Well, I mean,
Barry was not totally. But I don't know if we discussed it. That's when I met Barry. He started letting me be a contributor to the blog because I knew Peter Boofer, who I worked with. Back in Miller Tabak.
Yeah.
So I know Barry since the mid-aughts.
Mid-aughts.
I can't call it. It feels weird.
I don't know what that
the hell's
means.
an aught? What is an aught?
I'm not sure where it came up with.
Aughts or zeros.
Is that
That's
Latin?
where it comes from.
Is that Latin?
No.
Dan, is it possible that we? That
was quite a pivot.
Shit. Aughts. Can we avoid a recession, which economists seem to think is like 60+% chance of that? Can we avoid a recession and stocks still aren't cheap?
The short answer is yes, you can avoid a recession. The longer correct answer is no. I just find it hard to believe that you were going to tighten policy by this much,
Right.
this
Too much.
dramatically. I mean, listen, let's look at the housing market.
So what's taking so long?
This chart.
Because initial claims today still on the basement.
This idea of labor hoarding, by the way,
Do you buy it?
through the prism of jobless claims, yeah, but that still doesn't mean I should be adding 280,000 jobs a month. I mean, there's two different conversations here. Labor hoarding means I'm not firing them, but continuously hiring people is a whole other conversation. This chart, which I think you guys know about,
Yes.
is fine for viewers
This
or
is
listeners.
This is crazy.
Crazy.
To me, though.
What I've done
We
is
just spoke about this. The Bank of America earnings
Yeah.
showed this.
Hey, guys, there are people listening who can't see the chart.
Oh, yeah,
Let me
yeah.
explain it.
Explain the chart.
So for people who cannot see the chart, this is checkable deposits by wealth cohort in the U.S. banking system. And what I've done is I've rebased it to 100 around COVID, right at the end of COVID there. And
look at that.
what this shows you is that checkable deposits held by the richest 10% of the country is up almost 300% now as compared to basically at the end of COVID. And even the lowest percentage, the 50, I'm sorry,
90 to
The bottom
99,
50.
12.
Yeah, you're right.
yeah, the bottom,
Yeah.
yes. Did I include the bottom 50?
Yes.
the top.
Blue.
Blue.
Yeah, my boy.
Oh,
Blue.
yes, there we go. Yes, even the lowest banked customers.
So 3x.
Yes, have seen a meaningful. So when you say why hasn't it happened yet, there's a lot of money on
Still.
household balance sheets. There's a lot of money on corporate balance sheets, and ironically, that which caused the inflation, all the money we gave everybody, is somehow is not the right word, but is also preventing the recession from taking
So
hold.
we've been
to some degree.
saying this, but we didn't connect those dots. That is a very interesting, ironic observation. We've been saying for the whole year that the consumer and the corporation, because they hoarded on debt in 21, have never been better prepared to withstand a recession. Now, all of this excess, if it goes on, will burn off, obviously. But
yes.
but that's why it's taking
still
so
a
long.
trillion above. It's still a trillion above where it was in 2019.
What is?
There's a trillion in excess
Savings.
deposits, savings at banks.
Yeah, I'm not sure I believe all the data that everyone does. All the banks.
I don't even know how they calculate it, but
It's how much did income grow in a
Assuming
given month relative to
directionally-
where it should have been.
assuming directionally it's accurate, people have more firepower at their disposal than you might have thought, and that's what prevents the consumer from rolling over. And that's 70% of your
And that
economy.
works for now. A
Yeah.
lot of things work when the unemployment rate is 3.5%. When the unemployment rate is 4.5% and 5%, this conversation is going to be a little different.
All right,
totally
let's move
agree.
on. Let's get to earnings.
Okay.
Bespoke tweeted yesterday 35 earnings reports so far this season through yesterday morning. 71% beat rate on both EPS and sales, 9% raised guidance, 3% lowered. Actually, that's pretty good. I know it's early, but average one-day share price reaction, whatever, up 27 basis points. We'll take it. I want to highlight, because JB Hunt just reported, but this guy did a thread on trucking, and it was just the absolute perfect example of how COVID really fucked everything up and particularly made supply-demand imbalances go absolutely ballistic. So what this dude basically said, if I could sum it up, is that trucking is capacity constrained, and when there was so much demand, a lot of capacity came on the market, and now at the same time as demand is collapsing, trucking earnings are in for a world of hurt coming into the early 2023 time period.
Knight Swift told you that last night they reported, or this morning, I don't remember, but Knight Swift basically told you that. JB Hunt was a little better, but Knight
But
Swift.
they said inventories are high. You know, like I think.
But
again,
it's
this
just emblematic.
But this is a derivative of the goods services story that you guys are well aware about and that we talked about. Like the economy is shifting. And I know this is repetitive and we all know this, but it bears repeating. The economy is shifting away from basketballs and grills towards
Fayetteville.
Towards airline trips to Fayetteville.
But this is this is like the goat in the python, and you're just watching it work its way through, and it makes a stop everywhere, and like all the data that you would normally look at and be like, oh, it's a contraction, oh, it's an expansion. Just throw it out because it's so aberrant.
I am perfectly comfortable with the statement that, and I am solidly middle-aged in Wall Street terms, or I guess even maybe
Speak for yourself.
we're the same age.
I know, but still.
This is as confusing.
You were
an
born on the
environment-
same day.
But if you're not
same hospital.
I know it's crazy. Wait, if you're not comparing things to 2019, then just stop talking. Like that's when I hear somebody say, no, hold on. Somebody's like, oh, this is collapsing relative to fucking what? 2021?
Does he always say that?
From Chicago.
Like, is that your benchmark? What do you mean collapsing? Like,
One of the funniest things.
give it to me versus 19 or stop talking.
So two things. One of the funniest things Family Guy ever did was the Whipple episode.
Oh, that was great. Yeah, the Stewie. Yeah.
Phenomenal. When we go through companies, we have 2 PMs that basically have final say on everything.
It's Arkansas. Your flight is delayed. Put your phone down. Go ahead.
Every conversation is.
It's like, is this the show? He can't believe it.
What kind of romper room?
This is the show.
Every conversation is, yeah, but what's my EBITDA relative to 2019? What's my revenue relative to everything after that is an irrelevancy.
Right, it's crazy. It's crazy land. None of those stats should be compared to or relied upon. I'm with you on that.
Making matters more confusing is that not every company or every industry, every sector is saying the same thing. You have companies, Tesla, for example, and Elon might be full of shit. But what he did say was in the most recent earnings this week, I can't emphasize enough. We have excellent demand for Q4. And we expect to sell every car that we make for as far into the future as we can see. So, okay, maybe of course he's going to say that, but your thoughts on some companies being in wonderful positions right now?
The best advice I can give, and I do give to any younger person who's listening or meets with me or whatever, is read every conference call transcript or listen to every conference call you can possibly get your hands on. Yes, it's cheerleading, and you have to sort through the very esoteric semiconductor nanometer particulars that are irrelevant to you, but listening to what companies have to say is terrific insight.
Why do you think that's so helpful for investors? What do they get out of that they wouldn't get out of like reading newspapers or whatever? I agree with you.
The level of detail you get on companies themselves and industries is incomparable. You can't read a Wall Street Journal article and get the detail that management's going to give you. Now that's true to varying degrees, and the believability, obviously, you have to take it with a grain of salt because again, their job is in all public appearances to be as
but also listening to them, the inflection or the tone.
Let me tell you something about inflection and tone. Whatever the Mario Draghi, whatever it takes speech, if you read what he says we're going to do whatever it takes. Fine. When you listen to what he said. And this was at the time when I was at BTIG, this was my number one point to invest. This was 2012.
When they were about to embark upon Euro
saving Europe.
QE. Yeah.
He gave a speech and he said, we're gonna do a lot and it's gonna he said, oh man, now I'm screwing up the story, but he said, we're gonna do whatever it takes. Paused. He said, we're gonna do whatever it takes. And believe me, it'll be enough. And the way that he
was
said
at Jackson Hole, right?
I don't remember where it was. It was probably Jackson Hole, but the way that he said it was so informative to me.
Yeah.
The pause for emphasis, it was quite good. So you know, reading stuff is one thing, listening to it is another. But just to make the point, when you listen to what companies have to say, whether it's Procter & Gamble or Coca-Cola or even Nike, they are not telling me, and again, you have to take it with a grain of salt, but they are not telling me that there is some large-scale demand problem. The problem I have with corporate earnings so far is that pricing is up like 6, 7, 8, 9%, and volumes are all down for the goods companies.
And that's not sustainable.
And the companies and the volumes are all down 1 or 2%. And I think at some point that will.
Well, the problem that presents for the S&P 500 is that most of the earnings are coming from goods, not services.
In the S&P.
Yeah.
And the irony for this is for the economy as a whole, most of the economy is service-oriented, like 85, 86% of all jobs. So
that's interesting. That's a very big dichotomy. The S&P 500's earnings are coming from iPhones and cars and pharmaceuticals, like actual things. But the economy itself is coming from, hey, I just gave my personal trainer $80 for this morning's session, and you know my kid's nanny is coming over late. Like that's the real economy that we live in.
Josh, Elon was asked by an analyst about like a superstructure. If Tesla, they got would they buy SpaceX? And they were like, because what do they buy? They bought a Solar City, right?
Yeah.
Yes.
And he said, I'm not an investor. I'm an engineer and a manufacturing person and a technologist. So I actually work and design and develop products. That's what I do. So it's not. He basically said we're not going to have a portfolio like Berkshire.
So they're asking him like, why don't you buy more companies? Or
well, I think they said like, is Tesla going to buy?
Okay.
You spoke about this. Tesla going to buy Twitter. He said
It's
no.
still
One thing
gonna
he said that was pretty interesting. Several years ago, I said I think on our earnings call, and I thought it was possible for Tesla to be worth more than Apple. In fact, I see a potential path for Tesla to be worth more than Apple and Saudi Aramco combined.
Which implies $4 trillion in market cap.
That's belief. That's confidence.
When you hear stuff like that, what's your reaction? Strong no opinion.
Strong no opinion.
I'm with you. I thought it was cool that on the company slides he has himself listed as still techno king and CEO.
I mean, he's entertaining if nothing else.
He makes it hard not to pay attention.
But listen, if you're a CEO, it's no different than anyone having confidence in anything else. When R.J. Barrett says, I'm the best
Did you watch
player.
last night?
Of course I watched.
That was rough.
Yeah.
3 for 18.
rough ending.
But that's
Great game.
The
But
Grizzlies
he was
are
horrible. He was so bad.
Grizzlies are a real
yeah.
team.
Yeah.
So I don't fault him. He should. Every company should be like, I should be as big as Apple.
Okay. Alcoa reported, and remember earlier in the year, materials was like the hottest thing.
Sure.
Alcoa was up 60% year to date through March. It's now down 30% on the year, which is a remarkable year to date swing.
That high low up 60 to down 30 is, and this is like not a tech stock. This is like aluminum.
So their revenue, they said total third party revenue decreased 22% sequentially to whatever. They cited alumina and aluminum prices. Did you know that alumina was a thing? What?
It's a female version of aluminum. How did you not know that? Did you not take any biology classes?
So
at all?
I started to go down this rabbit hole of Alcoa's earnings report, and this is like CFA level 9 shit. It's like 180 pages. There's chemicals. This is way beyond my pay grade. But what I wanted to highlight was this: they generated $134 million in cash from operations. They repurchased $150 million worth of common stock, and they paid a dividend of $18 million.
They know who their investors are, I guess.
This is going to be a bigger story, though. A lot of the buybacks, the 2021 vintage, are looking really stupid right now. I want to get your take on this overall. It's not a pro or con buyback discussion. Here's Meta. This is from Barron's. Meta spent $48 billion and bought back 158 million shares, which was 6% of the stock outstanding. They spent an average price $304 a share over the last 4 quarters. So they effectively overpaid by $27 billion based on the current share price, which is now down 60% this year. It's 133. Think about what Meta shareholders could have done with that $27 billion not lit on fire, and some of the problems plaguing Meta now about burn rate from Meta investment. There are going to be a lot of these buybacks that look really stupid in hindsight. Yeah.
Yeah. Listen, I am generally in favor of companies returning cash to shareholders as much as possible.
But always, at all times, no matter the price.
What can you do better with money than I can do better for myself? So listen, I don't know that a buyback is necessarily. We can have a debate about whether a buyback is better than a dividend or just paying a special dividend every once in a while.
It's a tax debate, really.
Yeah, I mean, it's from a capital structure standpoint, obviously.
Yeah.
And also remember, from a valuation perspective, this sort of gets lost in the mist, so to speak. But buying back stock, I get that it juices EPS, but also remember you're taking cash off the balance sheet. So from a financial engineering standpoint, you're trading X for Y, and it's not as automatically beneficial as it might otherwise be. But as a general rule, I think companies should be buying back stock and paying dividends as much as they possibly can.
So if I said to you, Meta bought back stock at $304 a share, and now the stock's 133, was that, obviously it's hindsight, we don't know that's going to happen, but like, wouldn't it be so much better to initiate a buyback now? Or you could take the other side and you could say, well, think about how much worse the share price would be if they still had that 6% of more shares outstanding. I don't think that second argument really holds up, but what do you think?
No, listen, I have to dig, but I think Facebook generates an enormous amount of free. I mean, all those companies generate an enormous amount of free cash flow. You don't want them playing stock market any more than you want the Treasury playing Treasury market by ramping up or ramping down issuance at a whim. Listen, who knew? Getting back to an earlier conversation we had about the stock market being down 25%, there was.
Well, Facebook's down way more than the stock market, too.
Yeah, sure. I mean, then there's PayPal and a whole bunch of other companies.
CSX speed on the top of the bottom line. I've got 10 minutes. Let's get to it.
All right.
Get to what?
Whatever we're going to get to.
Yeah. Actually, we're coming into the home stretch. Did you have fun so far, Dan?
On a scale of 6 to 7, this is a 7.
This is a solid 7 for us?
It's a strong 7.
All right. We appreciate that.
No, in all seriousness, this is great. I don't know what took me so long, but
we're really glad to have you. I want to finish with something David Einhorn said in his letter, which just, I think it came out today, his Greenlight letter. Wanted to hear what you thought about that. He's having a great year. I think he's up 18% year to date, which almost nobody else is. A lot of humility. Like, I just got back everything that I underperformed going back to 2018. I still have a lot more work to do. Fine. This is him. other than Twitter, which was a huge home run for them, I guess they bought it expecting the deal to close. We did not add any new material positions during the quarter. We continue to be positioned bearish as we believe we're in a bear market. This differs from a correction in that a bear market takes time and is persistent. In a correction, buy the dip gets promptly rewarded. In a bear market, not so much. We haven't had a bear market since 08, 09. Our strategy is to remain position bear. I think he's right. I think it's a bear market. I like this correction behavior. Maybe it rewards you from one day to the next, but overall, this like knee-jerk buy the dip, it's losing this year.
But I don't think. Well, first of all, about Twitter, there were a lot of hedge funds that were just betting that when you go through the legalese, he's going to lose.
Yeah.
And he's what ends up happening is not that necessarily you're forced to buy the company, but maybe he has to pay a fee.
Yeah, I think Icon did the trade.
He said on the conference call,
did.
Elon said, I think everyone knows we're overpaying for Twitter. He said that on Tesla's conference call.
But Twitter aside.
The bear market commentary notwithstanding.
Are people buying the dip? I mean, listen, I think something you mentioned earlier, and I don't think we expanded on, Michael, was like we've seen weakness in housing clearly. And by the way, I don't know if people are aware of this. In the summer, the price of an existing home was up 50% or so from pre-COVID levels.
Crazy.
At no point in the housing bubble in the aughts was there a similar rate of change. Over the same period of time, housing was never, and there was a much more prolonged and persistent rise in prices, but the rapidity of the change in prices is incredible.
Yeah, it's breathtaking.
It's breathtaking. So anyway, so we've seen weakness in housing, but you haven't, only now the ISM is starting to dip below 50. You obviously haven't seen meaningful weakness in the labor market. So in terms of buy the dip, the argument I've been making publicly and privately for several months now is, so when those other items start to turn, I mean, you've got ISM new orders sub 50, but the index itself is still north. When you start to see those things turn, is the market going to rally on that when you start making the new leg lower in the economy? I don't know. If we pull up my final chart and then we'll let you catch your flight to.
That is the question. What is the market going to do when
last flight to Arkansas?
What is literally? What is the market going to do when the data turns? Is the unknown.
Yeah, initially it's going to rally because it's going to say the Fed is done.
I think that's right.
And then it's going to go.
Oh shit! Things are slowing down.
So earlier this year in the leveraged loan market, the leveraged loan market.
Yeah, we got this up.
I'll get to this in 1 second. I have so many points to make. The leveraged loan market is variable rate, so it benefits when rates go up. And to start the year, people in the leveraged loan market were like, "Oh, great, higher interest rates."
Right.
And then somewhere in like the second quarter, everyone was like, "Oh, higher interest rates." There's a turn, and I think to that point, like, "Oh, great, the data's getting weaker, the Fed's going to pause," and then suddenly people are going to realize what that means. What this chart is a rate of change in the federal funds rate in black, and this goes back, call it 30, 40 years. The 18-month change in the federal funds rate pushed forward, and the ISM index in blue on the right scale. And what you've seen historically, it's not 100% accurate or linked. And obviously post GFC, there's some weakness in the data because the Fed funds rate was 0. But what this is telling me is that you've got meaningful weakness ahead in the ISM index over the next couple of months. When that happens, the ISM is sort of the gold standard for Wall Street strategists when you talk about earnings in the economy. And if you're going to have an ISM dipping below 50 into the mid 40s, I'm going to start pulling down my EPS estimates. I'm going to start pulling down my economic projections. And that is not, to me, an environment that you want to be particularly exposed in the short term for stocks.
So that's where I am. I expect worse just because how could it not get worse? I just don't know how the market will react. So I don't know if the market will keep cheering a recession, knowing the Fed's done, once it rethinks, oh my God, it's a recession.
All right, well, our last segment for the day is we talk about our favorites.
But actually, let me ask a question.
What's on your mind?
Why can't you just leave and we keep going?
The audience
does he have the off button or something?
The audience would like that very much. I'm going to start.
By the way,
this is great.
Dan Greenhaus, ladies and gentlemen. Right?
Terrific.
Am I right?
I mean, only an hour.
Terrific. All right, New York sports. So I'm not a baseball fan, unfortunately. I used to be, but I broke up with the Yankees. It's too boring for me. The Giants are 5-1. I cannot actually believe it.
And
every
Knicks
year,
are an astonishing 0-1.
Every year, my friends and I, as a joke, we make a reservation to the steakhouse wherever the Super Bowl is, and we make reservations to the hotels. And
really?
As a joke, like we do it every year. But this is the year. No, it's not the year. But I'm having fun. I'm having a great time. And the Knicks, I'm encouraged.
What, you're a Knicks guy?
So I am a Yankee fan.
Okay.
And have been my whole life.
Jets?
And I'm not a huge football fan. I'm shocked they're 5-1.
Yeah.
And the Jets are 4-2.
Yeah, it's unbelievable.
And I'm a big Knicks fan.
Dude, the Jets beat Aaron Rodgers at Lambeau.
Yeah,
It might be the best thing
go
you
to-
could say as a Jets fan in 10 years.
Let's go to a game. Any game.
Oh, I like that idea.
Can we expense it?
Sure.
Mike has good seats.
I have tickets.
Okay, let's go.
So, but we look good. It's one game, but like the Grizzlies are very legit, and it's going to take time for our team to gel.
Knicks-
But we have a point guard.
The Knicks have spent years recovering from,
Bad. It's a long hangover.
and they are not. I mean, listen, they're not winning the championship, but this is a
We're
solid
confident.
playoff team.
We're play in.
I think
You got a favorite for us? Any books, any TV shows, any movies? We always leave people with like a favorite thing that people have.
people don't need me to tell them. Although I will say,
Oh, that being said,
Although I will say, let's go to that part.
well, first of all, I'm staring at More Money Than God, Sebastian Malaby's
Great
book.
book.
Great book.
Great book.
If anyone out there has not read this book,
I
this
agree.
is
Yeah.
one of the best books of the last 10 years
Absolutely.
by far.
Absolutely.
I agree.
You want to feel old? That book's older than 10 years old.
Really?
Yeah.
Oh my God.
Really?
Yeah.
But I read it within the last 10 years.
Anyway, what else?
I do. This is public knowledge. We had been it doesn't matter. We spend a good amount of time on content, so I can offer some TV shows.
Please.
If you like sci-fi and you've never seen The Expanse,
Oh, Barry likes that. I can't watch it. He has bad taste.
I
Wow.
started it. I couldn't keep. Is it like? Does it get better?
it's phenomenal.
I only watched one episode. I'm like,
yeah,
I'm
that's
not
good
saying
enough
that.
to make a decision on.
John, you're in. You're in on The Expanse.
Duncan?
Oh,
What about you?
I haven't seen this. What's it on?
You can watch them now on Amazon Prime.
Amazon Prime.
Oh, that makes it easier. Where was it before?
Sci-fi.
Yes, I don't even know what channel that is. All right.
Do you have linear TV?
496.
I don't know.
What do you got?
For pure fun, I listened to Nouriel Roubini on Joe and Tracy.
That sounds hilarious.
For fun?
Sounds so much fun.
Honestly, I got to relay one thing. He's basically like, for the next 20 years, we're going to be working off
Yeah, I saw
this
some
inflation
headlines.
thing.
All right, come on.
He
That's
said
not
that.
fun.
He said that in this crisis that's coming up now unfolding, you're getting the absolute best of the post GFC deflation and debt bubble, combined with the stagflation of the 70s, and that they're morphing into this like chimerical creature
0% chance.
that's going to be the worst disaster of all time.
Listen,
But wait, then the,
0%
there's more?
the answer to it is to buy real estate in the Midwest up into Canada. And that's like how you're going to escape it somehow.
Grand Rapids is recession
But the
proof.
way that he gets there is so serpentine and just artfully, and he throws in every like insurrection.
And he has an accent.
It's just
Do
honestly,
a lot of your investors, are they?
he's so good at what he does, Nouriel. Like so much respect for just the craft of combining everything everyone's afraid of into one continuous
but the
fireball of
suggestion
shit.
that-
Bye, Mike. We love you.
The suggestion
Safe
that
travel.
good luck.
Why are you going to Arkansas? The bagels? What are you doing?
It's definitely not the bagels. The suggestion that the solution to that is to buy land in the Midwest.
It's amazing. You
How
just
ma-
have to listen
No
to it to
disrespect to
understand.
Nouriel, but how many people can realistically?
No, he's like, you have to buy tips, gold, and like not live in Florida is the way,
What
is the
about not
way to
Florida?
survive.
What about baked beans? Wasn't that Kiyosaki who said to buy baked beans?
I didn't listen to. but
Kawasaki, the jet ski?
No. The
Robert
Kiyosaki, yeah.
That's a step too far for me.
I don't know who that is.
He was Rubini was
Sorry.
great. Rubini was. It's like an hour of just pure like you are all gonna die right now.
You know,
It was
but
amazing.
the interesting thing about that is in the post GFC that gave birth to that cottage industry.
Yeah.
Appears to have not really waned at all.
No.
And pre-GFC, it was largely unfunded liabilities and so how are we going to pay for our debt? And it was this esoteric looming debt bomb. But everyone sort of acknowledged that what post-GFC,
Well, now the debt is so the argument is the debt now is even bigger than it was,
which is true.
which is true. And we weren't worried about inflation in the post GFC. We were worried about the opposite. Now you have not only screaming high debt levels, private, public, all over the world, plus you have the inflation thing that the Fed's going to have to wreck the economy to solve.
So-
that's the. I'm not saying like what. Look at this.
What up, dog?
So much fun. Thank you.
Thank you for having me.
Sit down.
Are you
got
allowed
Barry
to do
Ritholtz
this?
to replace
All right.
Michael?
All right.
Where are you coming from?
I'm coming from Jeremy Siegel and Jeremy Schwartz.
Duncan, put more batteries in. Let me say.
He said something. I said
is
I
for
would
me?
love you to get I'd love you to sign this for my partner Josh. They're going to come on the show in November with you
Oh,
guys.
this is beautiful. Thank you
so,
very much.
Dan, how the hell are you,
I miss
man?
you so much, sir.
How's it going?
We were telling big picture stories.
I was
From way back when.
and I was saying my first sort of I wasn't saying, but I
Conference.
alluded my first real public anything was through Bookvar.
Right.
And you let me write
On the blog.
on the blog.
That was like 1870, 1880.
How old was he when you let him write? You haven't let me
12.
write
It
on
was
the
at his
blog
bar
yet.
mitzvah. That was my bar mitzvah present.
I haven't been able to write on the blog yet.
You have your own blog.
That's
No,
not
is that
true.
not enough?
I've had your posts
I think you've republished my stuff.
multiple times.
You were never like, Josh, here, write something.
And let me-
Dude, you had your own thing, and all I would do is point to it.
Yeah.
And hold on a second. I'm going to
know.
interrupt because now that you're both in front of me,
Yeah.
let me indulge me for a second.
We're recording this.
This
so-
is fine.
Okay.
Indulge me for a second. I want to give you both
Keep
your
it clean.
flowers. I want to
Keep
give
it
you both
clean.
your flowers and say
Ooh.
I have known you both for many years.
Right.
What you have built here is really impressive. The Masters in Business program.
Oh, I thought you were
is-
talking about this room.
No,
'Cause this
the-
room is really impressive.
The bookcase. I assumed you built the bookcase. I know
Yeah.
you're very handy.
By-
But in all seriousness, it's just really to see
Thank
you
you,
guys
Dan.
doing so well is just so.
We appreciate that. Thank you.
And I don't want to say I love you both because I don't, but it's really just great to see.
we
Tell us
appreciate that.
which is your favorite child. That's the pick your favorite.
I would never.
He wouldn't dare.
So
No, but-
so we just keep doing our thing, and we're happy to just keep
I
plowing
mean,
along.
would you say? And I'm only half joking when I say this. Would you say that you have revolutionized the RIA industry through the constant?
No, I'll tell you what we've done, and correct me if I'm wrong about this. First, since we launched this business not from an RIA but from watching other people do it wrong, we emphasize, and this is why I always love Ray Dalio. We emphasize the figure out what you're doing wrong and learn from it and get better. So we've tried a lot of things that we've screwed up, and fortunately, we've been very iterative and constantly improving. I think we made people aware of the fact that there's a different way to do it. So I don't think we revolutionized anything.
When like if you think about the RIA business, think about the biggest firms, they were all built by personalities.
Sure.
Like
Rick Edelman,
Ken Fisher. These
Right.
are $200 billion firms now.
Peter Mallouk.
So we
go down the list.
didn't really invent any of that.
We
but
followed them and just took it in a little more modern direction.
I think we're like a little bit more Ben and Jerry's than those guys, though. Like,
Right.
like a little bit more like.
And that's because we're both fat bastards who love dessert. That's the big. That's the big reason.
Understandably so.
No,
Right.
we're just a little. I think in the end, people want to do business with people they like, people they trust, and I think we've given people a lot of reason to like and trust us. And thank
So
God.
stop and think about what we did that was so unusual. Is
We don't have that much time.
we launched.
Why don't we have time? What is there? We're cutting to commercial.
No, okay.
Where do
No,
you have to be?
It's Barry.
But-
You have no idea where this
Yeah,
could go.
we'll be done by breakfast.
It's
We're
our
but-
dinners that you.
but keep
you never
in
came to the
mind-
dinners. Our dinners were like 4 hours long.
I
Yeah,
know.
right. But
I've been to one or two.
But they're 10 people. That's why 8 people.
Sarah Eisen taps out at the 2-hour mark.
No, Sarah was there on
doesn't
Wednesday.
stay for the-
She
all
Oh,
stayed.
and so there's still dinners, and I haven't been
Yeah,
invited
so
in
it's
10
just
years.
Jim Chanos, Paul Krugman. It's a
Sure.
rotating group of people.
Does Michelle Meyer still go?
She was there this week also.
Oh, so all the old people go, but me.
You didn't hit Dan? See what
it's-
happens when you go incognito for 6 years?
when I go to the buy side, all of a sudden you don't get
Gone.
invited to these dinners anymore.
But our entire attitude was, let's see if we can do this better than other people. And when we launched, we were nationwide with an office in New York. People had to know us and trust us. Otherwise, wait, I'm going to give you $1 million and have never met you. This was pre-pandemic when that
Sure.
was an SOP. Now, it's,
Well, that's the weirdest thing about us is most RIAs, it's like a guy at Merrill or UBS, and he says, you know what? My next contract is up. I'm not signing another one. I'm going to go do my own firm.
Right.
They look around the town they live in. They say, what's a mountain or a lake nearby? Okay, that's the name of the firm. They have a membership at the golf course or the
Bryant
marina.
Park Capital.
That's all their clients are like local, and they're like a big shot in their small
Sure.
pond. And then if they're successful, they expand and they expand outward. We were inside out. We were like, hey, there's a few of us. We're in New York. All our biggest clients are in Texas, California, Washington, D.C. Made no sense.
Yeah,
No one's ever done that. We did that in we started
13.
we started the firm in 13, but we were doing that in 2011.
Yeah.
10 years before the pandemic, doing 99% of our business over the computer.
virtual screen
So I
share,
think that's the weirdest.
FaceTime.
That's the weirdest thing about us. But that's now become the norm.
Right.
So,
we were built virtual. We were built for the cloud from the beginning because we had no choice. Between my media footprint and now Josh's even bigger media footprint, our audience was nationwide.
you know what they
And-
say about big footprints, right?
Size doesn't
Right.
matter.
Right. you know,
The footprint size is not that important. Agreed.
but its reach, our reach was far. We punched far over our weight, and our weight is not insubstantial.
But the whole thing would have collapsed had it been wholly reliant on Barry and I trying to figure out what to do for, like, we have since staffed to like 54 people, and we've got CFAs and CFPs and people who are experts in tax and trust and estate. There's a lot of expertise behind the scenes that people who are fans of the content or the blogs, that if you're just relying on what we're doing public, it would never have worked. So it always had to be an ensemble. It would never have worked. It was just the two of us, like, what do you think of interest rates this month? That's not, that would not have gone very far.
Full credit to both Josh and I guess to myself for recognizing
full credit. That's generous.
full credit.
Really brave of you to give yourself credit.
No, I'm going to go out on a limb here and say both of us are smart enough to say, I don't know jack about tax, but we have the Bills who are tax experts. What do I know about putting together a financial plan the way a true CFP expert does? So we have built this really, really solid bench of people who all have a very deep expertise.
Are we recruiting or
what?
Are we recruiting him now?
No, I'm just kind of explaining.
You can't afford
pull my
me.
spring and.
All right, wait. All right, we are going to wrap, but I want to thank you for popping in here. And
so
it's
if
pretty
you
cool.
read the inscription, it's very lovely.
What do you got for us?
Can we get a favorite from Barry?
A favorite what?
Yeah.
A favorite book, movie, TV show, something right now to recommend?
So wow, I'm in the middle of a couple of really interesting things.
Can't be House of Dragon.
The most interesting
No,
book
it's
is
an obvious.
Yeah.
It's like saying you love the Beatles.
The Price
so good,
of
though.
Time: The Story of Interest Rates by Edward Chancellor.
You're not reading that.
I just interviewed him yesterday. I read that, and I reread Devil Takes the Hindmost, which this guy writes the book, publishes the book in '99. Devil Takes the Hindmost about speculation, and now his book on interest rates comes out this year. Like, talk about auspicious timing.
What's the conclusion of the book?
Rates are important, and in fact, interest rates are the single most important financial number that has ever existed or will ever exist.
I think that's entirely there's the original
gravity.
That's
Rates
right.
of gravity.
The original interest rate book, Homer something. I'm blanking on.
Yeah, Scylla. Richard Scylla.
That's right. Or whatever. The history of interest rates.
5,000
History of interest rates.
Essential reading.
It's.
but that's a tome.
You can't
that's
read
a-
it. It's a dictionary. You can't
No,
read
it's,
it. But
you put it on your shelf and you refer to it when you need it.
I
but-
met him. He's active with the. There's a Museum of Finance.
Yeah,
in
doesn't
New
he run
York.
it?
So I met him. Somebody introduced me to him at an event.
I did here. He was here.
That was here.
Yeah.
Okay.
Richard Siller. It's the book on my shelf.
The book is this times
Bigger.
two.
Right, it's much bigger.
It's a thing.
It's a thing. It's a whole thing.
Do before we let you go. I'm.
right.
No, you're co-hosting
Wrap it
now.
up. Take us out.
Do we want to thank our sponsors, Schick. Do you pop into? Should I be flattered that you came in here? Is this normal?
Never. It's first time.
So my schedule is usually Tuesday, Wednesday, and they record Thursday. But sometimes I'm in on Thursdays.
Well,
and
look at what
I
a
didn't want to
lucky-
interrupt. Oh, and the other thing is not book but streaming. The third season of Orville is really good.
Oh, that's the guy from Family Guy.
Yeah.
It's
haven't watched
McFarlane.
Seth
It's
MacFarlane.
surprisingly good.
Josh told me you
Go
like The
back
Expanse.
and watch
Yeah, you like The Expanse, right? Wasn't that you?
Oh my God! The Expanse
Yeah.
was my two favorite things from the lockdown was The Expanse,
Yeah.
and Altered Carbon. Altered Carbon.
The first season of
is-
Altered Carbon is exceptional.
Can I tell you something? The second season holds up surprisingly well.
People told me it wasn't good. I didn't watch
Oh
it.
no, I'm a junkie, so I'm down that rabbit hole, and I'm really.
I moved right on to Bridgerton.
So that was fun. Both seasons were
Okay,
fun.
I need a new show. I should. I'm watching the Elizabeth Holmes thing, The Dropout.
That's good.
See, really,
I finally
enjoyed
got
that.
to that.
I can't.
I want to watch that and the WeWork one.
The WeWork one was
WeWork
interesting.
one is fun.
Was really interesting.
It's not a straight biography. They
I
take a
watch
lot of
anything with Jared
liberties.
Leto.
It's real. That's a lot. That one's a lot of fun.
I actually tagged Galloway and say, who's the guy who they got you to play you? Is terrible. He's half your height. He looks nothing like you, other than the fact he's got no hair.
What are we doing?
I was just telling you to remember to talk about your shirt before we get out of here.
Oh, well, so we have these up already. We teased these and they weren't available, but now they are. So this is the official Jerome Corleone shirt. It's available. idon'tshop.com. A lot of people on my Instagram were like, where do you get that? We finally got them up. We sold a lot of them already, right?
We have.
Yeah, but they're limited edition. We're going to stop.
And the proceeds go where?
to us.
Straight to Jerome Powell.
Yeah, no, this is not like a.
Wait, I'm getting paid for this, right?
What's that?
Exactly.
You're getting paid in shirts. All right,
Is this a boys' medium?
it is.
Okay.
All right, let's wrap here. Our thanks to Barry Ritholtz, Nicole, who kills it every week, John, who kills it every week. Round of applause for Duncan and the legendary, now back out of the shadows in the public eye, Dan Greenhaus. Thank you so much for being here today. I hope you had the best time. We had a great time
Great.
with you.
Thank you.
And Michael had so much fun, he had to literally run out the door. He just couldn't contain it.
Scared him.
No, we had a great time. Thank you for joining us. And guys, we will be back next week. Thanks for listening. Make sure to leave us a rating, a review. It goes a long way. We love you. We'll talk soon. All right, take us out.